Hi, everyone. Thank you so much for joining us today. I know we are at the top of the hour, so everybody is still kind of trickling in, but we have a lot to get to today, so we're just going to dive right in. So welcome to part one of the Analytics Reimagined series. As a reminder, this is just part one of three. And this series was designed to help you transform your strategic planning using predictive analytics to optimize product pricing and portfolio performance. Today, our panel is going to provide insight into the top three things winning organizations need to succeed in the next 3 to 5 years. And just a few housekeeping notes as we get started. All participants are muted to prevent background noise. We are recording today's session, and we'll be sending the recording and the slides out to everyone within the next 2 business days, so be on the lookout for that. And we did reserve time at the end to answer questions. So to submit those, just click on the Q&A icon at the top of your screen and submit those at any time. Submit those as you have them throughout the entire webinar so that they're ready for us to answer at the end. And just a quick note, because this is a live event, there may be a little bit of a presentation delay as the slides are advancing. If you notice that, just know our presenters are going to keep going on with the material just because we have a lot to cover and we want to make sure that we get through everything and make the best use of everybody's time today. But know that the presentation will catch up. So no worries on that, and everybody will get the handout so you'll be able to look through everything in its entirety. All right, so let's meet our panel. So our moderator for today is Mark Bogalski. Mark is an Allied Solutions Senior Vice President with more than 30 years of experience working with financial institutions to help maximize revenue and mitigate risk through consultative business solutions, strategies, innovative ideas, insights, and best practices. And our panelists are Dr. Joe Breeden, CEO of Deep Future Analytics. Dr. Breeden has been designing and deploying risk management systems for loan portfolios since 1996. He founded Strategic Analytics, a leading provider of credit risk and capital management solutions, sold to Verisk in 2010. And he founded Prescient Models in 2011, which focuses on portfolio and loan level forecasting solutions. He co-founded Deep Future Analytics in 2013 to bring solutions to credit unions and community banks. Mike Bryan is Vice President of Digital and Data Strategy at Allied Solutions. Mike leverages his 20+ years of experience in digital business leadership, innovation, and entrepreneurship to help companies realize winning business results with digital technology to expand their value proposition, enter new markets, or drive business process and customer experience optimization. And last but not least is Jack Imes, Lending Strategy Sales Specialist with Allied. Jack has years of executive lending experience with both credit unions and banks. Recently, he served as the Chief Lending Officer at JSC FCU, a $2.65 billion credit union. Previously, he was the CLO at Honda FCU and the VP of Commercial Lending at US Bank, among other top lending roles spanning over 2 decades. At Allied, Jack brings his credit union and bank experience to serve as a consultant and advisor to our clients and sales team. We have some really great knowledge and experience on our panel today, so I'm really looking forward to a great discussion. And with that, I am going to hand it over to Mark.
Thank you, Alyssa, and welcome to our attendees. Thank you for joining us today. We know that many of the financial institutions on the call today have aggressive growth goals going forward. One of our objectives at Allied Solutions is to help you meet those goals and do it through the use of predictive analytics. So with that, we're going to really dive right into our topics today and hear from our panelists and talk about some of the top things that winning organizations have shared with us in terms of what they are focused on to be successful over the next few years. We will concentrate on 3 specific areas today. The first of which is adapting to fast growth and changing business models. The second is navigating economic risk and uncertainty. And then finally, we'll talk about boosting business productivity and profitability. So for each of these topics, we will discuss, have our panelists discuss the current environment throughout the industry and different trends that we're seeing, but also then talk about how predictive analytics can help overcome these challenges and actually get ahead of the competition and create an environment for success. So we're excited to get into this and share some information with you that will be beneficial for everybody on the call. So the first thing we're going to talk about is preparing for growth and the changing business environment and models that we're in. The headlines are out there, and we can all see them. It is, and they're pretty common when you look at some of the things that are happening within the industry today. There's a few consistent themes that jump out. Mergers and acquisition is certainly one of them, and we're seeing a lot of activity with credit unions actually acquiring banks. And then, of course, we're seeing the surging interest rate environment that will potentially have an adverse effect on loan growth and profitability going forward. And then finally, one of the other consistent themes we're seeing is the gravitation of financial institutions moving and investing with fintechs to help with their business. So with that as background, let's shift gears here and hear from our panel and get their perspective on some of these specific areas. So with that, I'd like to start with Jack Imes. Jack, as you look at the M&A activity that's been out there, and I know you're out there talking to a lot of our clients, what kind of questions or concerns are you hearing from the market specific to some of these headlines?
Thanks, Mark. And certainly in 2021, there was a record number of transactions. And as you alluded to, already this year, we've seen that flurry of activity in the first quarter. And I think the biggest challenge we hear out in the marketplace is, should we even be considering mergers or any type of acquisitions? Certainly there are merger advisory firms and lawyers and accountants that assist with that process, but having a proactive analysis of your existing balance sheet and P&L in place under various economic scenarios is the critical first step. And here's the reasons why. You'll have that strong baseline to build from, a needs assessment, if you will, as you're even thinking about mergers, whether it be with banks or other credit unions, and also things like buying deposits, branches, or even making investments in fintechs. You want to look at both your existing portfolio today and then under any possible future economic scenarios. I hear a lot of this in talking to folks when they say, think about where the market was a year ago today versus now. And you can easily see we're looking into that future, and having that economic analysis is so critical, especially if you're thinking about making an investment, Mark.
Yeah, that's great insight, Jack. Appreciate that. Just staying on the topic of fintechs, I want to shift gears over to Mike Bryan. Mike, as you look at fintechs and you look at the environment out there, what are some of the opportunities that you see in partnering with fintechs versus trying to build it in-house?
Sure. Yeah, great question. So, one of the areas that's really topical now, folks have a lot of deposits on hand, and everybody we're talking to from the executive suite's really talking about, how do I expand lending, right? I need to get more loans in. So there's a whole bunch of strategies they're employing, which is, how do I increase volume? How do I expand my credit box, right? But understand the risk that I'm taking on. There's fintechs talk about using alternate data to give you a different slice of consumer potentially. Geographic focus, hey, I'm expanding beyond my geography, all those sort of things. So there's a whole bunch of technologies out there, everything from open lending to Upgrade, LendKey, Rate Genius. There's LP opportunities as well. So through companies like New Look Lending and Symmetry and a whole bunch of others. But ultimately, that all kind of rolls into, you really have to get comfortable with their underwriting, right? So that's the question, is what are the loans that they're underwriting, and do you really feel comfortable with the yield and forecast that you're going to get? So that kind of brings you into the second piece, is where analytics comes in, right? So fintechs, we often think about creating digital experiences, expanding lending, all those sort of things. But a fintech like DFA, where you're really understanding that forecast and yield, what am I bringing in? How am I, after I buy it, looking at it and saying, am I going to get the yield? What's the profitability, the cash flow? Am I going to get the return that I expect? these are different than the traditional loans that you're taking on. So ultimately, expand your lending, get comfortable with the underwriting, but have predictive modeling where you're really looking at future forecast of the value of that.
Thank you, Mike. Appreciate that. And you're right, there's no shortage of fintechs out there, but you referenced DFA, and I want to switch over to the CEO and founder of DFA. Joe, a question for you. When you think about some of the strategies that have been successful, that people have deployed, especially going into the environment that we're about to jump into, high interest rates, increased risk, what are some of the strategies that you've seen people take that make them successful in that environment?
It's a great question. There are times when demand is high across the board and it's almost like you can't do anything wrong. There are times when there is no demand anywhere. We are in between those. It's a rocky period. Rates rising is going to hit different consumer segments in different ways, different products in different ways. So it becomes about segmentation and projection. Look at the product you've got, ask what is the forecast horizon you need to be thinking about. A 5-year auto loan is really a 2.5-year loan on average. And so what's the environment during that period? And how do I price for where I am, and not just overall, but go in by segment. If you're looking at mortgage, mortgage demand is going to fall overall. But where are your strengths and weaknesses as an organization? Where do you have market reach and operational efficiency? And can you leverage that to be more competitive in certain segments? So it always, in this changing environment, it's a very segmented approach to finding where you've got opportunities.
For sure, and analysis sounds like it is the key. So with that, Mike, I'm going to go back to you on this one. Can you elaborate a little bit more on how financial institutions can use predictive analytics to evaluate growth opportunities in this environment?
Sure. Everybody we talk to is talking about more. I need more loans. I need more assets, right? I need to grow my member base, my consumers that I'm engaged with. But ultimately, the first key point is kind of builds on what Joe said, which is prioritization, right? You can't be all things to all people. You can't go after everything. So who should you focus on, right? What are those segments? What are they really worth to you, right? And then when you map it out across a profitability spectrum and risk spectrum, not everybody's worth the same, right? Not every loan's worth the same. So some of the biggest tools that you always have that are most flexible to you are pricing strategy, volume, and financial forecast. So your pricing strategy has to be really, really dynamic in a dynamic environment, which we're really coming into. So that's probably the first one, right? That's at hand that you've got available to you. As we talk to a lot of folks, though, they look at market pricing or use spreadsheets to have a good discussion. There's a lot of industry expertise, obviously, with folks that are in the C-suite and in the lending expertise areas, but getting a number behind that is really critical. So using things that they use in airline industries and consumer retail is critical. The second, Jack hit a little bit on that M&A side. When we talk to customers, relationships are usually a key part of it. I know that this executive is going to be retiring, or they're going to look to transition, but ultimately, in a dynamic environment here, there's a lot of opportunity. So being proactive with how you're monitoring M&A opportunities and then how you're modeling those as well. So if a credit union buys a bank, it's not just a book of loans. You've got a whole new book of risk and opportunity, right? And you've got to look at how that fits into you. Or if you expand geographically. So that's going to be a big part of it as well, is that M&A is not just buying something, but part of your diligence and part of your ongoing forecasting. And then the last piece is having enough data, right? Anybody that's attending this and has been out there at all for the last couple of years, they hear big data everywhere you go, right? Everything's big data. It's almost become a bit of a joke, Companies are leveraging big data to pick which ice cream flavor you're going to like, whatever the case is. So, but ultimately you have to have enough, right? So enough breadth and history to navigate what's going to happen in the economy. I know Joe will talk a little bit more about that, but having enough data across products, across volume, across diversity of geographies and products is going to be really critical. And this is how predictive analytics can really help you see the way forward.
Excellent. And one of the things that I think is most exciting about the stage that we're in right now is we're in this phase where we now have access to actionable analytics, which really speaks to the three things you just mentioned, Mike. So we're at a good time and place to really make an impact through the use of predictive analytics. So that is certainly exciting. And one of the things that's less exciting is this economic environment that we're in, and just the uncertainty. It's I think everybody on this call realizes we're no longer in this business as usual type of mode, and there are certainly unpredictable, choppy waters ahead for all of us. So really getting an inside look on how we can manage through that using predictive analytics, I think, is going to be probably more important than ever, in really kind of getting to that opportunity of really getting to some level of stability through predictive analytics. So, I said a lot there, and we're about to see even more to back that up. And none of this is exciting. It's actually fairly depressing when you think about the road ahead of us here. But we're in businesses that we all have to manage and adjust to this. So, Joe, I'm going to go back to you on this one. With all the concerns I just outlined and what you're seeing right here, and we've got inflation, rising interest rate environment, recession risk. Could you talk a little bit about what you're seeing from your perspective, because you're out there across the world right now, literally, and you're seeing a lot that maybe others aren't. But what can people expect that's around the corner?
Yeah, I think we're surprised at where we are compared to what we thought we would have just a few months ago. In January, we were talking about inflation, but most of the projections were for a solid 2022 and continued growth at some level. Now we're concerned. The war in Ukraine is causing significant supply chain disruptions related not just to energy, but all the follow-on things. Energy gets used to produce things. And we can't ignore what's happening in China. They have a zero COVID policy, which honestly is not really sustainable. And that is also going to affect whether they have a recession this year, and that can affect our supply chains. So, we're seeing major economists out there say that there's a 30 to 40% chance of recession next year. Traders are pricing in even higher risk than that. We can't ignore that. Now, it becomes very product specific when you think about this. If I've got a 6-month personal loan, well, maybe I don't care so much about next year's inflation, recession risk. I'm worried about inflation. But if I'm booking mortgages and auto loans that have a longer term horizon, when I'm thinking about pricing, I need to price in a forward-looking way. If I'm going to do a loan participation and buy somebody else's tranche of loans, I want to run scenarios. And too often we call this stress testing and set it to the side as a separate exercise. But really, we need to think about these stresses at every transaction we're making.
Without question. Thank you for that, Joe. And Mike, I want to ask you this next question. It's, we talked about just the environment, the rising interest rates, and inevitably that's going to have an impact on loan quality at a minimum, loan growth possibly as well. So assuming loan demand decreases, you've got increased loan delinquencies, charge-offs, compressing margin. What would be your advice to financial institutions in managing through that?
Sure. Well, I would say it depends on if you're a TIGR or EOR, right? So if you talk to a lot of economists, right, they're all mostly EOR, right? You can always predict, well, it's all going to go bad, right? But the TIGR says, hey, there's opportunities here. And with a dynamic environment, if you look at the history of companies that have really grown dramatically, it's been when there's been challenge and choppy waters, right? So there's going to be a bunch of opportunities here. Joe mentioned a little bit about investment. I use that kind of reference. I would use the same for financial institutions, right? You're going to have to look to diversify, right? So expand your lending into different areas, right, where there's going to be risk and environmental things that impact you. We talked a little bit about M&A opportunities. Not everybody's doing that, but I'll say everybody I talk to says, I'm open to it. It's not in our strategic plan, but I'm open to it, right? And if you're taking on these different types of loans. So diversification is going to be a big piece of it, really understanding the risk that you're taking on. And, we talked to a lot of executives. They're saying, hey, I think I can take on more risk, but my board remembers the last recession, or I can't really quantify how much we can take on. Again, that's where forecasting and modeling says, hey, under these different scenarios, we feel pretty comfortable we can take on this kind of risk and get this kind of return. There are real profit opportunities here. It's not just doom and gloom, right? With rising interest rates, if you can navigate it well, there's better margin, right, throughout that process. I think the last piece is where you're focusing on in terms of your best customers. So most credit unions and banks have rewards programs. So how are you tying profitability and rewards to real results, right? So tie the analytics to what you're doing and what you're going to reward with people. I guess the last is the winners are going to look to grow here. They're not going to hunker down and say, hey, we'll wait it out. So folks that are going to grow dramatically, as we talk to credit unions, they're trying to go from $1 billion to now $3 and $5 billion. It's going to be these big chunks that they're going to grow in this kind of environment.
Perfect. Thanks, Mike. Appreciate that insight. Jack, one of the things that we've seen over the past couple of years is this huge influx of deposits that have come into financial institutions. No guarantee that's going to continue in the future, and most likely it will not. So what are your thoughts on that, and how would you advise and guide folks to manage through that potential change in the deposit shift?
Yeah, I think you're spot on, Mark. I mean, our clients are saying, as it relates to this excess deposits, they're saying, what's next? So as you look at this slide, and there's data to back this up, there's an understanding out there that some segments of the population have spent their excess deposits, have spent some of these, while others are taking, as you can see from this slide, they're taking a wait and see attitude, a wait and see approach. So over the past several years, by and large, we really haven't had to worry about a deposit strategy or deposit modeling with all these historically low rates and all these excess deposits coming in. But now as these rates are starting to take off, coupled with this uncertainty as it relates to these excess deposits, it's now more than ever critically important and prudent to have that deposit and loan. Everybody talks loans, but talk about deposits and have a optimization strategy, a model for deposits and loans where you can truly forecast and take a look at profitable relationships and how that impacts not your P&L and your balance sheet, Mark.
Great points and insight. Thank you for that, Jack. So looking at everything that has been said in that last segment, Mike, I'm going to ask you, what can financial institutions do to prepare for the road ahead, given some of that feedback that was just shared?
Yeah, this dynamic economy that we're a part of and going into is going to be one of the biggest drivers of opportunities, risks, and results here over the next couple of years. And as folks say, "Oh, I can't wait till things get back to normal." I don't know if we know what that is. This might be what normal is. I mean, think about what we've been through, right? The discussion about a pandemic. There's a war in Ukraine, which impacts us all, right? We are global. Then the supply chain impacts, right? Then the price of housing. Who would have expected used car values to go significantly up, right? Unemployment, GDP, all those sort of things. And oh, by the way, we're coming into a political season again here, right? So there's going to be a lot of dynamics here. So, the first big thing is really, Joe referenced that real-time stress testing, integrating economic scenarios into your forecasting and modeling. A lot of folks we talk to say, hey, go out and look at a bunch of websites. We talk about it. I don't have a way to attach it to what we're doing every day. So that's the first one. That's integrated economic scenarios. The second big piece is account level detail. And that sounds easier than said for a lot of folks, but a lot of reporting and analytics will tell you how much, but what they don't give you is who, right? Who should I go target? Where are my proactive opportunities for upsell and cross sell? Where are the real risks there? That gives me an opportunity to say, let's take that next action. That's harder than most people think. So that gives you the charge off, the prepayment, but also the opportunity. So get down to the account level. And as Jack was talking about the deposit modeling piece and how analytics comes in, there's, again, back to the Tigger part of this, there's opportunities. So not only what cash are you going to have on hand to lend out, but also this gives you a chance to optimize price and hopefully attract some new members and consumers, right? You've got a product opportunity just like you had lending, right? Prior, it's on the lending side, we always talk about there's rate shoppers or people that you will get approved. On the deposit side, now you've got an opportunity to create some new products that can hopefully attract and retain some of your members as well.
Excellent, excellent. Thank you. And obviously, the time to predictive analytics is critical there. So let's shift gears and talk about probably one of the most pressing things that we're hearing from a lot of the organizations that we've talked to is how do we optimize productivity and profitability? I think this is something that everybody is dealing with, and there's no shortage of data that supports the concerns around productivity and profitability. And one of the things that I hear when I talk to CEOs probably most consistently right now is hiring and retaining top talent, which is, I think, something everybody is challenged with out there today. And, you know, the other probably consistent theme that I'm hearing is how can we shift and pivot to this remote digital environment to meet the needs of how our consumers want to be served. You know, it's interesting, just looking at some of these graphics here, we've seen some organizations actually close branches and reduce their geographic footprint, but yet everybody's looking to grow. Everybody's looking to improve their performance metrics. So you've got some unique dynamics that are going on there. And I guess maybe the big topic that seems to be out there right now is hiring and retaining. And Jack, I want to ask you, you work with our clients every day. What are you seeing in terms of hiring and retaining people, and what can you share with the rest of the group on the call?
Thanks, Mark, and you're spot on. We all hear about and we read about these staffing shortages across the country, regardless of whatever type of company. But the interesting thing that we're hearing from clients is that as they're trying to staff up and they're looking at their staffing models, obviously not only was it due to your P&L because you got to pay up to get these folks, but there's a lot of moving parts because there's also the impact of new technology like artificial intelligence, and how is that helping your bottom line? Getting a mixture of that human capital and technology capital, and what's that cost? Not just what does it cost today, but what's it cost next year as you're trying to forecast out around the next corner and over the next hill, as I like to say. What's that model look like in future dollars and future economic scenarios? So not only is it difficult to get the folks, you're juggling that. You got to pay more for them, and you're also juggling the cost of technology, which is going to help your bottom line as it relates to some of these costs. So the biggest thing you can do is have a piece in place where you're measuring that human capital cost. You're measuring the technology cost against these various economic scenarios. And I get back to what I said at the top of the call. I just constantly remind folks, look where we were a year ago today in those economic scenarios, and look what we're facing now, and not just today, but going forward, Mark.
Yeah, it's interesting, this data-driven perspective that we keep kind of coming back to has always been something that's out there, but in today's environment, it seems even more important than ever before. The other thing that's critically important is the need and the desire that consumers have for convenience, specifically when it comes to digital engagement. We're seeing this sweep across all the verticals that we work in here at Allied. And Mike, you had that up for Allied, and would be interesting to hear from you as to how that's changed and how it's going to change the way that financial institutions do business as more of this digital demand comes into place, and what can you do about that?
Sure. Yeah, obviously, I better know something about it with digital in my title and spent 20 years doing this. But, ultimately, it comes down to the investments that you're making and are you able to connect them to real value? There's table stakes that I think everybody expects now. So you've got online banking, you've got a mobile app, you're looking at digital account opening and a lot of those sort of things to grow your volume, to create experiences, to retain your members. But the place to focus in on is starting to do the analysis of, again, matching your portfolio and your business results against these investments in technology and who's using them. Our online banking members, are they actually more profitable? Are folks that are using your other technologies or other investments, are they more engaged? Are they staying with you, right? There's analysis that you can do on that to say, the investment we're making here, we should do more of. I know there's a lot of technology that's enabling organizations, creating an experience, helping optimize their overall operations, but you can't do all things, right? So if you orient yourself around the consumer profitability that flows into your business, that probably gives you the best opportunity here to maximize it. So it's going to be the expectation, but you got to prioritize here for sure.
That makes absolute sense, especially on the prioritization side of it. And it's also clear that you're going to have different expectations and behaviors from in-branch to online consumers. They're going to have different needs. And it's important, I would think, for everybody in this business to understand what those needs are by consumer segments. So, Joe, can you talk a little bit about how we can really get a deeper understanding of what those needs are and really speak to those individual consumer needs, whether they're online or in branch?
Mm-hmm. Well, the main thing we look at is campaign tracking. And when I say campaign, I mean that kind of generically. Each month you get in a new pool of accounts and you'll get them from different channels and you may get them from a specific marketing campaign. But even if you think you're trying to do things uniformly, you're going to attract different groups of consumers. And not only is it what you're doing, how you're trying to reach consumers, but the environment affects this also. We talk about rising interest rates, depressing mortgage demand, maybe auto loan demand, things like that, but it doesn't do it uniformly. Certain consumer groups, in ways that are hard to measure, it's hard to predict who this is going to be, but we see that certain groups drop out in a certain rising rate environment, others stay there. They don't necessarily have the same credit risk, even if they have the same FICO score. All of this means, whether it's online or interest rate driven or whatever, you need to be doing tracking. And so that tracking is not just what are my delinquency rates, but how do they compare to my expectation? How do they compare to my pricing? Because ultimately, the purpose of tracking is to be able to make changes. In this environment for this segment, I'm going to have to shift my cutoff scores or my pricing a little bit or whatever it's going to be. But if you're not doing that, you're going to be reactive instead of proactive. And that's what we want to avoid.
Yeah, and there's no room to be reactive in today's environment. We really have to have a future proactive focus, all of us, in any side of the business that we're in. Okay, well, moving to kind of a summary here of this section. And again, I go back to this is such an important piece of what we're talking about today because productivity and profitability is top of mind, I think, for every attendee on this call today. So it kind of leads us to the big question, Mike. And the reason we're here today is how is this concept of predictive analytics really addressing the productivity and profitability objective that we're all trying to achieve?
We've talked in this discussion about balancing diversification versus focus. right? And how do I expand and limit my risk by diversification, but how do I focus on my most profitable consumers and segments? That's where analytics really helps you. Ultimately, we're trying to put this into a number, right? We're trying to put it in front of everybody. We've got experience in the industry, you've got intuition, but let's quantify it on a range of options, but not just what it is today. What you're looking at is a forecast, right? So you said it very well. Let's have a forward-looking view of what the future might be, right? That's that GPS view. So analyze and understand what might be ahead, right? Second is really those understanding those investments that you're making, facilities, right? Some organizations are expanding their footprint from a geographic perspective or from opening branches. So what is your goal from that branch? What do you expect to get? Some are opening in those in CDFI kind of areas because they want to grow lending in that. That's fantastic. Again, take that, track that, as Joe said, and then be able to forecast under those scenarios and say, what is the impact that's having? And last, it's said there 3 times, pricing, pricing, pricing. If you think about, A, B, C, D, E paper, think about going to the grocery store and top shelf, middle shelf as you go down, right? There's a whole lot of dynamics that happens when you grab something off of one shelf versus the next, right? They're tracking what's our volume, what's our flow, what's the pricing in different geographies. So pricing is almost the number one opportunity you've got in retail right now in a very dynamic environment to optimize results and get ahead of competitors, not just match what they're doing, as we hear a lot. Hey, I look at our competitor and we're 25 basis points lower, but how do you optimize for your consumers that you can be most profitable on? The whole idea behind this profitability piece is so that you've got the ability to capitalize on this environment, right? So you've got more profitability to invest, to grow your business, to take on risk, to make acquisitions or do what you want. If you don't, right, then you're running a little bit thin. So that's the whole part. It's not just productivity for productivity's sake, it's productivity for growth's sake.
You couldn't agree more. So thank you for that insight, Mike. And as we start working towards the conclusion of our time today, I want to take just a minute here to thank the panelists, the expertise that Mike, Joe, and Jack have brought to our conversation today. And as we kind of digest everything we've talked about, the question that resonates in my mind right now is, okay, this is all good stuff, helpful information, but what's the actionable takeaway that I can leave this webinar with? So I guess I would turn to you, Joe, and just get your insight and perspective on what would you say some of the specific things folks on this call today can leave here with maybe a different understanding than what they came in with, and what can they do going forward to help their financial institutions? And then once you answer that question, Joe, what I'd like to also do is then open this up to some Q&A for any of the attendees that we have on the call today. So kind of make it a little bit more open-ended. So with that, Joe, I will turn it over to you.
Well, we talk about these being volatile times. It's not the first time we've had volatile times, and we're not the only country that's had those. I've had the fortune from a career perspective of having been assigned to countries going through volatile times for the last 25 years. And consistently, the winners are the ones that are forward-looking from a portfolio perspective. And forward-looking means, of course, in their loss reserves, but also in their pricing, in their account management. The losers, and you can see this easily just from the 2009 mortgage crisis, were the ones who were backward-looking in pricing, taking what the market would offer, not looking forward on their loss forecasting, and not sufficiently analyzing their own performance data to see where things were going wrong, which segments weren't working. We know how to do this, and it's not new. So the key is to be forward-looking, and you can only do that with analytics. Although if you're a good manager and I tell you losses are going to go up this much, you may know that intuitively. Mm-hmm. Our job is to quantify it in a way, bring it down to segments and accounts so that you can integrate that with your business. And it's not enough to do it in one place. You could say, yeah, we've got our loss reserve set, we're ready for a recession. But what about everything else you're doing? You cannot survive if you've got different groups running different programs on different assumptions. And this is something else we've seen. So that consistency and coordination across business function is essential. And that's why we focus on having an internally consistent analytics platform, not a different model for every different function giving you disconnected answers. And when you do this right, you're looking across pricing, portfolio performance, loan participations, M&A. It's not just how does it look today, but where is it headed? How will it integrate with my portfolio in the future? All these things we can do. It's more just changing the culture to want to do that and make it a key part of the business.
Excellent, thank you.
Awesome. Thank you so much to Mark and our panel for such a great discussion. But yes, we have plenty of time right now to take your questions, so please chat those in. And then as a reminder, the webinar, again, is being recorded, and the recording and the handouts will be sent out to everybody in the next couple of days. Everybody who registered will get those, so be on the lookout for that. And then do save the date for parts 2 and 3 of the Analytics Reimagined series. You're already signed up, so if you're on here, you don't have to do anything other than being on the lookout for a calendar invite with the login information, so you can make sure that that is reserved on your calendar so that you're able to join us. The next one that's coming up is June 9th. We're going to be talking about what you need to be doing to make sure that your compliance solution is auditor ready. And then towards the end of August, we'll be looking ahead to 2023 strategic planning and how analytics can help with that. So now I would like to take a look at our Q&A and the questions that we've had chatted in. So we had a question: what role do scale and consistency in processes, how do those affect credit unions' ability to compete in an ever-changing marketplace?
Joe, I thought you were going to take that one.
Well, I'm trying to decide which of us is going to take that one. When you talk about scale, to me, scale means a couple of things. There's an operational efficiency, of course, that comes with scale, but I always look at the data. Scale brings data, and the more data you have, the better you can understand the effectiveness of what you're doing, whether you're getting shifts in quality. Now, we have a solution to that. You may need to grow into an area that you haven't historically had scale, whether it's commercial lending or you want to offer HELOCs or something else. That's exactly why we run this shared data pool. So that if you have scale in some products, but you want to grow in commercial lending, you can leverage models and insights coming from a shared data pool of the entire industry. So that's how I look at it.
And Joe, it's interesting, and you and I have talked about this. Scale for the sake of scale, for the sake of size, is not the answer, right? It's exactly what you just said, which is putting the pieces of the puzzle together and analyzing what works best for you in your market, with your members, with who you're serving. And some people think that a certain size is the answer, right? Get me to so many billion or whatever. I think the real answer is exactly what you said, which is analyzing what you have in front of you, what the market you can get from the market to serve the market, and then that profitability piece is the critical piece. Joe, you're spot on.
Well, and to follow up there, just examples I've seen. Scale does give you data, gives you insights, allows you to adapt. But if it's scale for scale's sake, as you said, now we're talking about Washington Mutual. We're talking about some famous blow-ups where they said, hey, I've created a machine, I need to run everything I can through it, but they weren't looking at the output of their machine. And that is not the way to go. So it's got to be scale used intelligently.
Awesome. Thank you both. And so I'll give this one to Mike, so I'll start assigning them. What are some specific examples of predictive analytics that we should be trying to develop?
I know it sounds like a broken record. I think that first one is, pricing, right? I mean, it's really looking at that piece, right? And whether you're using, hopefully deep feature analytics, but really understanding where the opportunities. And most folks that we talk to say, I go into an ALCO meeting, we've got a spreadsheet, we're kind of talking through it, but I can't really quantify it, right? That's really, really important. I think that second piece, and I mentioned my background in technology, but I started a career in marketing, and really that segmentation and targeting is really, really important. Who are we going after, right? And this kind of builds on that scale discussion we just had. Hey, I want to add 20% more members. Why? What do you define as a member, right? The conversation here is, well, I've got a mix of direct and indirect members. Well, how many of those direct members have 3 or more products with you, right? How many equate you as their financial institution, the primary institution, and you've got a relationship with? So certainly pricing is something you can look at, but that member primacy and who are we targeting? Who are the people, if we could find another 20,000, 50,000 like that we really want to go after to drive your marketing strategy. Those are probably the 2 areas I'd focus on, is who are we going after and how are we going to price them? And then how are we going to retain those members?
Definitely. And so this one is directly related to DFA. So Joe, I'm going to give you the first shot at this one. So the question was, how does Deep Future Analytics differ from other data management platforms?
Well, there are a lot of data management platforms, and that's not our thing. We're not just trying to visualize data. That is great and important, but we are focused on the predictive aspect, making models that can create forecasts, and it's not an easy problem to solve. When you want your model to be account level, to look through the full lifetime of a loan or a deposit, to consider competing risks of charge-off and prepayment. If you look at the ways there are to do that, that's a hard problem. If you don't solve that well, you can't use the same model for pricing and CECL and the various things that we're talking about here. So what sets us apart is that we spent a lot of years and a lot of research figuring out how do you do that so that you can consistently solve all these problems, not just a least necessary solution for CECL or a minimum acceptable solution for LP. And that's what we wind up competing with, is others who have a collection of minimal solutions in these areas. That's not enough.
I'll say, the part that got Allied excited and why we invested in Deep Future Analytics, and it's been validated in the market, is the whole idea of an enterprise solution, right? So we're hearing that a lot from CEOs, CFOs, innovation or risk officers that, hey, we might start small, but I know that this will work across our organization for that one source of truth. So just as Joe said, there might be separate tools or reporting platforms, but the idea that, hey, I can grow into this wherever I want to go has really resonated with a lot of folks.
Awesome. Well, it looks like those are all the questions that we have. So if anybody has any, get them in quickly so we make sure that we can address them. But I did just want to thank everybody for joining us. Again, remember, this is just part 1. So we have, a couple other parts left that are coming up. So be sure to get those on your calendar and join us again in June. But thank you so much for being with us here today. And thank you to Mark, our moderator, and to our panelists, Joe, Jack, and Mike. Thank you all so much for giving such great insight and sharing, what you've been hearing and what you've been seeing in the industry and hearing from our clients. So really appreciate it. Thank you all. I hope everybody has a good rest of their day.
Thank you.
Thank you.